Hey everybody, welcome to TenX Profits. In today's video, we're going to be looking at the market this week of September 8th, 2025. Alright, so right now we're looking at the Monday. Today is Monday, September 8th. We're looking at the credit check. So the credit check consumer credit is starting at 2 p.m. So what we're looking for, the numbers, is not as important as you can see is highlighted here in the yellow. We're looking for anything that is market moving, which would be in the red. So the rest of the week for Tuesday, Wednesday, and Thursday will be market moving. As of today, is a low news day. That's the reason why you're seeing the markets going up right now. As you can see, Bitcoin's going up and SPY is going up. So yeah, that's the reason why the market's going up, because we are in a yellow for the news. So anytime there's low news or not market moving news, the market's most likely going to go up. So no news is good news, as they say. So we're looking for the next following days. So right now the market's going up because the news is not very significant, but we're also paying attention to tomorrow, Tuesday, September 9, which will be the jobs benchmark revision. What that is it will reveal how many jobs. If they reveal fewer jobs, it's like the economy is weaker than we thought. So Fed more likely to cut, or stocks, crypto shear. If more jobs, Fed feel less pressure, markets may wobble. This is a sneaky big event because it changes the whole scoreboard. For Wednesday, September 10 would be the factory prices. So at 7:30 a.m. it'll be the PPI, producer price index. Think of this as the cost at the factory before goods hit the shelves. If it's hot, it's like the oven is overheating, inflation sticky, Fed cautious. Cool, even cooling CPI tomorrow may also be cool. So green light for stocks. This is like the trailer before the main movie, which is the CPI. And then Thursday, what we're watching is September 11, the main event. At 7:30 a.m., it will be the CPI, Consumer Price Index. This is the knockout punch of the week. If the CPI is hot, prices rising fast. So Fed hits brakes, stocks dip. Dollar strong, crypto stalls. So if CPI is cool, Fed steps on gas. Stocks, crypto rip higher. So Europe's central bank speaks right before or after CPI. If they sound dovish, ready to cut, it adds wind to our sails. If hawkish, it can dampen the rally. And then at 7:30 a.m. Central Time, jobless claims, quick health check of the labor market. As price spike adds fuel for rate cuts. So at 8 a.m. Central Time, OPEC oil report. If oil supply looks tight, gas prices up, inflation risk up. If supply looks loose, pressure off inflation. So Thursday is the most important day. Everything else is a warm-up. And Friday, we finish off the week with the wallet check. So 9 a.m. will be Michigan consumer sentiment. So this is, imagine asking the crowd, do you feel good about money right now? Well, if people expect prices to stay high, Fed stays cautious. If people expect prices to cool, Fed more confident to cut. This tells us if Thursday's reaction holds into the weekend. Alright, so what does that mean? Action for you. If CPI is hot Thursday, expect red light. Stock dips, better to hold cash or take profit. If CPI is cool, green light is a good week to DCA into Bitcoins, Lana, Tesla, anything that you have high conviction for. ECB tone, Thursday, a dovish Europe can turbocharge a rally. Hawkish tone may cap it. So Friday's sentiment confirms whether we head into the weekend confident or cautious. Okay, so now we're looking at the 10x market timing that we have curated. So we are using algorithms to automatically populate these data. So for our long-term liquidity, we're at 84%. For the last 7 days, we're up 25.4, which is great. So basically our long-term liquidity, we have tailwind behind the rally here, so which is very bullish. Short-term liquidity, we're at 50%, and that's the reason why we're at mix right now. We're in a choppy range in the short term, but the long term we're looking good at 84% liquidity. We do have 50% corrections potentially happening within the next 7 to 12 days. So that means that our status right now in the short term would be mixed. We are in a neutral, but we're still bullish long term, so it could be choppy for the next 7 to 12 days. So right now the 10x tracker shows strong long-term liquidity tailwinds, 84%, meaning the bigger trend supports higher markets over the next few months. However, in the short term, next 7 to 12 days, things are choppy and uncertain, with a 50-50 split between rally and correction. So the big picture, institutions have plenty of liquidity to keep markets trending up, but the short term, expect volatility. It's a waiting zone until leaders align. So the actions that we want to do would be not to chase green candles. We'll stick to our DCA plan into high conviction assets like Bitcoin or Solana, MicroStrategy, whatever you believe in for your portfolio. But at the same time, we're going to keep some cash ready to buy the dips, since a correction could happen in the next 7 to 12 days. These are liquidity flowing out in the short term here. Okay, so the reverse repo liquidity is leaving, so money market funds are pulling cash out of Fed's reverse repo facility and moving it back to the system. We don't want to see that. We want to see it flowing in. The Treasury General Account, so which be withdrawing liquidity. So the US Treasury is draining liquidity, is issuing bonds, building its cash balance. So this acts as a headwind for stocks and crypto because money is being pulled away from risk assets. Okay, so that's not what we want. We want all this to be in the green and to be clear sailing ahead. This is the Fed continues quantitative tightening, so shrinking its balance sheet. So this is removing liquidity from markets, another drag on risk on assets. So this is the reason why we are having a sideways markets. We're in a range right now because short term the liquidity is leaving from the reverse repo, from the Treasury General Account, and the Fed balance sheet. This is in the green. Inflation adjusted bond yields are falling, so which is bullish. So this is bullish for risk assets like stocks and Bitcoin and so forth. The dollar is falling, which is great, which is bullish. And M2 money supply is also rising, which is very bullish for the markets. So in summary, the Fed and Treasury are still draining, but the dollar and yields are easing, giving risk assets some breathing room. Think of this like driving uphill. QT headwind, but with the wind at your back, falling dollar and yields. So we can move forward, but momentum is fragile. So keep a watch out for that. And our technical trend, which is the short-term trend for the SPY here, we are in a uptrend. The uptrend for the market right now, strength is 43%, which is decent, not over 50. That's the reason why we're in a choppy market right now. The exhaustion for the uptrend is at 17%, so we're not close to 100 just yet. So we would be worried if we're over 50, 60, and 70. Right now we're only at 17 exhaustion, so we still have more room ahead. The reversals, short term, we are at 51% in the next 1 to 3 days. That's because we're in a range. We are still in the uptrend above the 200 moving average. RSI is at 59%, which is not overbought or oversold. We don't want to be over 70%. That's when the market is going to pull back. So we are at the 59%, which is still somewhat bullish. In summary, the market is still trending higher, but the daily chart shows weakness under the hood. It's like running uphill, momentum is slowing, and a stumble in the next few days is possible. So we still got to be careful. So we're going to stick to our DCA. We're not going to chase green candles, and we're going to be ready to buy the dips before the next leg higher. So that's basically what we have for the market. We are today green of 93%. Tomorrow, potentially 93%. Tomorrow's actions, we're going to DCA and still buy. We're still buying and nibbling because we are still in a range. Next 2 to 3 days, we could still see a 50% dip because we are still in a range. So again, be careful. Look for this in the next 7 to 12 days. We could be pulling back. We could be heading in a corrections in the next 7 to 12 days. Okay, so we're nowhere near top or bottom, which is good. All right, so short-term movements, we are mixed. We're in a range. Long-term movements, we're in a long-term tailwind, which is very bullish in the long term, so which is good. So the summary for that. So long-term movements, long-term tailwinds. So big picture is still bullish. Liquidity supports higher moves in coming weeks. Okay, we're still in a choppy market. We're not in a full bull market just yet without the breaks, so still cautious. Okay, so today's actions, we're going to be buying today, DCA before the close. Again, since we're in a range market, we got to be careful. We're only nibbling into high conviction stocks. So the reason why, again, tailwind is building, which is good because the short term, the fix is steady, SPY is above moving average, dollar is falling, M2 is rising, and so forth. Again, we're going to trade light. We're going to respect the levels of resistance and supports. We're going to DCA into high convictions, and we're going to use stops if we are trading. All right, so that's what we have for you today. So if you like the analysis today, please like the video. Bye for now.